Hello students. I want to talk a little bit about the basics of a stock market and what it is and why we play with it a little bit. I want you to write down some of these terms. So let's go ahead and get started. What is a stock market? And it's just one type of investing. There are others like savings, bonds, real estate. So the stock market is just one. But here's some terms that I want you to write down and then have available for class because initially as we start, they will be new to you and you'll do better if as we talk about it, you can look it up very quickly. One is debt as it is applied to stocks. Debt can be applied also to an accounting equation or for accountants. Equity as it is applied to stocks, and that also has a meaning in accounting or business, but we want to talk about it with stocks. Stocks, what are stocks and why would a company buy stocks? Bonds, what are bonds and how are they different than stocks and why would a company sell bonds? And then the risk factor. All investing carries with it a little bit of a risk factor, some less risk than others. And as a rule, normally the higher the risk, the greater chance for return or the greater chance that you can make more money. So let's go ahead and get started. When we start talking about stocks and bonds, we're talking about how companies can raise money. If you are Apple and you needed to raise $300 million so that you could build a new plant and do some research and design, etc., and build some new items for your company, there's two major ways that you could do it because that's way too much to be able to just borrow from the bank or to have in savings, although Apple has that much in savings. They don't want to delete that. So there's two ways that they can gather a lot. One of them is to borrow the money, and when they borrow the money, they don't borrow it from a bank. They actually create bonds. And when they create bonds, then people out in the community and out in the world buy those bonds. And the reason we associate bonds with borrowing money is because as they do that, Apple or whoever company you're buying it from promises to pay you back that money plus interest on that money. So it's like going to a bank, only they're selling those bonds to individuals. And individuals like this because the interest that they get from like Apple would be much higher than they would get from a savings account. And how safe would Apple be? Probably pretty safe right now. So borrowing money is one way they can do that. As we talk about borrowing money, again, they promise to pay back the money plus interest, and we call this debt. And the reason we call this debt in the stock market is the company is actually taking on debt, and so it reflects on their bottom line. When companies have a high debt, then they're not as well liked or so from others because they're so high in debt. But this is one way they can get money. The second way that this company can get money is through stocks. Stocks are just a little bit different, but they're the same idea in that they can raise the $300 million. If you want to raise the $300 million through stocks, what you're actually doing is selling part of the company to those people that buy the stocks. So you're actually selling part of that company, and those stockholders actually own part of the company. That might sound really nice, and it is. But here's some differences. When you buy stocks, Apple doesn't have to pay any of that money back. You incur the risk of losing that money from the stock if the company doesn't do well. So Apple likes it because they don't have to pay it back, and they've gotten $300 million. But if it's an advantage and a good investment, you can actually make more money by selling these stocks later on if the company actually does better than what they're doing now. Now, the term we use with this is equity. And the reason it's equity is because Apple doesn't have to pay this money back. It increases the equity in their company simply by selling stocks. So let's look at each of those a little bit closer. When I buy a stock, the stock is a share of the ownership of a company. So you actually become a part owner of the company. And holding a company stock means that you are one of the many owners of that company. Doesn't mean you make lots of choices. They usually will have a CEO and others, but once or twice a year they will have a stockholders meeting. And if you have a lot of stocks, and so you're part of a major holder, then you can have input on decisions for that company at that stockholders meeting. Stockholders meetings can hire and fire the bosses and encourage them to go different directions in their company, etc. Now here's some terms. Stock is the same as shares. If you hear shares, it's the same as stocks. Shares are shares of stock is really what that's referring to. Equity is also the same. And again, the reason we use equity in that is Apple has more equity in their company because they don't have to pay that $300 million back or whatever they issued. I have an example of a stock uh, on the screen. Most people don't get these anymore. It used to be that if you would buy stocks, you would in the mail get so many stocks, and it would show how much you bought that stock for, and you would just keep that. And when you got ready to sell it, you would send it back in. Because of the buying and selling of so many stocks, we don't do that anymore. Those stocks are there, but usually they're kept in holding places, and you just have your name attached to so many stocks, and it makes it faster and easier for you to sell them or to buy them or to work with that. So you actually won't get those shares now, but here's an example of what one might look like. Now let's talk about bonds. A bond means the company has borrowed that money, and so they're going to have to pay you back, and they have to pay it back with interest. You can buy bonds from companies or you can buy them from the government. Here's an example of a bond from the government. And this is the way the government can make money. They can sell these types of bonds, and we used to hear a lot about it during World War II, about selling bonds so the government could make more money to finance the war, World War II. And why would people buy a bond? Well, bonds are usually considered a little bit safer than stocks because if you're going to a good company like the United States U.S. government bond, probably it's going to be pretty safe. So you might get 3 or 4% interest on your bond rather than what you would get in a savings account with 1 or 2% interest. So again, a little more risky, but if you have $50,000 and you want to make extra money rather than just setting it in the bank for 1 or 2%, you can increase quite a bit by putting that into and buying bonds for it. And again, here's an example of a bond, and again, the banks will keep this for you, but that's the difference between stocks and bonds. Basically, they're helping companies finance themselves. Bonds, they borrow the money from you and pay it back. In stocks, they sell you a stock and you become a part owner. So here's some advantages and disadvantages of each, and some of them we've already talked about. On debt or bonds, when you're doing bonds, the company has to pay back the debt plus interest. So that can get expensive. But if a company is doing very, very well and they think they have a very good product, then after they pay that bond back and they've paid the interest, they get to keep all the extra profits, and those profits stay with the company. The major decisions for how to run the company stay within the company. So the owners or the CEOs still get to make those decisions because you don't get to make any as a bondholder. That's for the owners of the company to do. Now, a company that has no stocks is called a private company. And we have big companies out there that are private. I think Hershey's is one where it's just a family that owns all of that business. And they sell bonds, but they don't sell stocks. And so they get to keep all the profits that come back in. But they have to pay the money back with interest. So equity or stocks has just the opposite effect. The company does not have to pay the money back. They like that. The profit, however, is sent to the stockholders. Now, the company can keep some of the profit to increase um, redo machinery or buy land or some of those things. But if there's extra profit left, it doesn't stay in the company and it doesn't go to the leaders of it. It goes to the stockholders because they're the owners. And so you can make some money on stock from um, stock by doing that. And they call those dividends, but we'll talk more about that later on. You get to help make the major decisions. The stockholders make that. And again, if you're a major stockholder, you could have quite a bit of say in what the company is doing. And company with stocks is called a public company. And the reason it's public is people can buy stocks from that company. So it's kind of a fun thing. So hopefully you can start to see the advantage of bonds versus stocks. One is a little bit less risky. The more gives you the opportunity probably to make a little bit more money if the stocks are doing well. If they're doing poorly, then you can lose more. So again, that risk factor becomes into play. So the last thing I want you to think about is if you had some money and you wanted to invest it, you could put it in a coffee cup and keep it at home. That's not very safe. You could get robbed. If the house burns down, you lose it. It's just not a very good way to handle it. Plus, it's not making any money for you. You could put it in the bank, get some interest on it. You could buy bonds. That would help make a little bit more money than if you put it into a bank. Or you could invest in stocks and possibly be able to earn more money than even bonds or savings, but there's more risk. And so everybody has to kind of find out what kind of risk factor they like, and then they can invest those monies in those areas. Good luck.